Hello and welcome back to this channel on value-added tax. In the last chapter I told you that in the European Union for cross-border deliveries we have basically three different legal solutions for how a cross-border delivery of a good from one state into another state of the EU has to be treated. And I told you there that the optimal solution for such a constellation is that if a supplier from state 1 sends a good to a buyer in state B, that then in the state of destination, the buyer is usually the best person who should make the tax payment. That is exactly that solution where we are going to talk about in this small video. And so we will have to find out how that idea can be transposed into law. And well, for the buyer, this will be transposed by the rules on intra-community acquisition because, well, the buyer buys, so he acquires. And for the supplier, the same thing will be called intra-community delivery and will entail some rules and obligations for the seller too. Well, let us first remember where we are in the overall chapter on cross-border activities. We are here in 2.3, the cross-border sales of goods in the EU. Well, if we have now the idea that we want to make a buyer taxable with purchases from another EU state in the country where the good goes to, for reasons of simplicity, then we need rules within the law which exactly order that, and we need to know where to find them. Now here you see a mass of arrows that just helps us in the course of time here with that little smart chart, because, well, we will have to set or lay out the rules in our law according to the same testing scheme as always, because that is convenient for the user of the law. So we should design laws for taxability, for tax exemptions, for a tax-based determination, for the tax rate, for formalities, tax arisal, taxpayership, and so. And last but not least, for under which circumstances persons can get input tax. For example, when the buyer can claim input tax for the tax which he paid on the acquisition of a good which came from another member state. Now let's begin at the beginning. And the first thing which we need is a principle which says, apart from deliveries made by an entrepreneur or services made by an entrepreneur, also acquiring a good from another member state can trigger taxation. For this we need exactly another number, so that would be number 5 of the USDG. It's number 5 because it just has been added at last to the list of potential taxable transactions. And now then we also need to define the details of that. And this will be laid down in paragraph 1a and in paragraph 3d. Now let us first have a look to these rules. Well, here are the taxable transactions. You see paragraph 1, subparagraph 1, number 1, 2, 3, 4, and last but not least, the one we need here, the intra-community acquisition of goods in the inland for consideration, so against payment or against something in return. Now, here we have some technical terms again. Intra-community acquisition in the inland. When does it happen in the inland? These two things must be defined in a closer way, and so we need now to have a look on the definition of intra-community acquisition. And here it is. 1a, paragraph 1. An intra-community acquisition of a good is defined as follows. Such a thing is given if the following conditions are met. A good gets from the customs territory of a member state of the EU into the customs territory of a different member state, or from other parts of the customs territory of the community into the areas mentioned in 1.3 USDG. These are the so-called free harbor zones, and we can forget about this. Well, the basic thing is, number one says, an intra-community acquisition can only happen if a good changes from one member state of the EU, to be more precise, from the territory which counts as inland of that member state, into the territory of another member state. Number two, well, what do we expect now? We expect that the intra-community acquisition rule only applies if the buyer is a person who is capable or can be expected to follow VAT rules correctly. And you remember there are three potential groups of buyers: the full experts who know everything about value-added tax, the full idiots, on the other hand, private persons who can never learn correctly the rules of value-added tax, from whom you, for this reason, never can expect that they could pay the tax, and the people or the persons half the way in between, the so-called half entrepreneurs or half experts or half idiots, the ones who do not yet hand in regular VAT declarations, but from which you could reasonably expect that they could be forced to learn it. So we need now, or we expect now, a second number which says the purchaser must be one of these persons. And indeed, 1A1, number 2, the purchaser or acquirer is an entrepreneur who acquires the good for his enterprise. Here it is. Or a juridical person who is not an entrepreneur or does not acquire the good for the enterprise. So people who are either already doing read and write, or who could at least learn how to read and write under the value-added tax aspect. And a third condition is something which is so evident that we probably never thought about it. VAT transactions are only taxable if the supplier, the deliverer, is an entrepreneur. So naturally, that could or should also be a restriction in case of a cross-border situation. If a private person sells something second-hand or so, this should not trigger VAT. And so the intra-community acquisition of goods is also limited to cases where the deliverer is an entrepreneur and not a small entrepreneur, but a regularly taxed. Yeah. So we find this basic definition here in the text of the law. The three numbers just express what we had already expected. Intra-community acquisition number 1 can only happen if a good crosses the border intra the community, so within the European Union from one state to the other. Second, if the buyer is a person capable of declaring VAT. And third, natural condition, if the whole thing has been sold by an entrepreneur. Now we still are missing the rule about the half entrepreneurs, the people in between. There we would expect from our basic ideas in the last video that these buyers are only forced to declare and pay intra-community acquisitions if they buy on a bigger scale. So that must be somewhere, and so let's have a look where we can find that. And well, if we have a look, naturally we find it in the third subparagraph of paragraph 1a. You find a restriction. An intra-community acquisition as defined in paragraphs 1a, subparagraph 1, or subparagraph 2, we did not yet talk about the second subparagraph, is not treated as an intra-community acquisition. So you can forget the intra-community acquisition problem under the following circumstances. If the acquirer is one from a list of 4 letters and the total amount of payments or things in return given for the acquisition as defined in the paragraphs 1a and 2 did not exceed 12,500 euro during last year, or in all probability will not exceed the threshold during the current year. Exceeding the threshold during one of the years is sufficient in principle. The idea there is, if last year you surpassed the threshold and you were forced to hand in a VAT declaration and to learn how the rules work, then you can also do this year. Naturally, makes sense. So let's go a bit backwards. We would now expect that the list of acquirers for whom this threshold now applies is nothing else than the list of the half experts or half idiots. Those people who have a basic knowledge of business and taxes, have a bookkeeping, but do not yet hand in a VAT declaration, but where you can suspect they could learn it if it really is worth learning it. And indeed, look to the list. If the acquirer is A, an entrepreneur who has only made tax-free turnovers up to now, which preclude the claim for input tax. What does that mean? If you have, let's say, a medical doctor who only makes medical treatments free of tax, this entrepreneur then has not to pay any output tax, and this entrepreneur also has not to claim any input tax, because free output cancels input tax. That means A describes an entrepreneur who, due to tax exemptions, does not have to hand in any VAT declaration up till now. So forcing that entrepreneur to pay taxes on an acquisition of 100 euro from, let's say, Belgium would trigger a tax of 19 euro and would trigger enormous fees for having to make a VAT declaration and enormous bureaucratic effort. So this is evidently correctly described as a half idiot. If that medical doctor, for example, has 100 turnovers free of tax, but 1 or 2 beauty surgeries not free of tax because it's not curing a disease, it's not a medical treatment to heal people. If there is at least 1 or 2 beauty surgeries taxable, then that entrepreneur already has to hand in a tax declaration. Then he is classified already as one of the regularly taxed entrepreneurs. Then no half idiocy, no half expertise, no half entrepreneurship anymore. Then that person is already classified as regularly taxed and there is no threshold granted anymore. So the stress is here on the only tax-free turnovers with no input tax claims. So no need, not a single line until now to hand in a tax declaration. Then B, an entrepreneur for whose turnover value-added tax is not claimed under paragraph 19, that are the so-called small entrepreneurs. They are entrepreneurs, but if they don't want to, they don't need to hand in a tax declaration. You know, there is a rule on the small entrepreneurs, people who have very small turnover over the year, usually perhaps don't know about the tax obligations. It would be very problematic if you really send everybody to prison who earns 100 euro turnover per year and doesn't pay value-added tax on the 100. So these people also do not hand in a tax declaration, they get a threshold. An entrepreneur who uses the good for turnover for which the tax is assessed according to average tax rates under paragraph 24 these are farmers taxed under a specific farming scheme. They also do not hand in regular tax declarations, so also there we can understand why these persons are classified into the group of the half experts or half entrepreneurs. And last but not least, juridical persons who do not have an enterprise or do not act within the enterprise can also be classified as half entrepreneurs, because you already heard that in the last video. Juridical persons always need a bookkeeping, and if they need a bookkeeping, they also have some person at hand who has a basic understanding of legal issues and of business affairs, so they could learn, or they know somebody who could learn how to hand in a tax declaration. That is the reason why these four people really are classified into the group of the half entrepreneurs, those people who only have to pay taxes on their acquisitions if they acquire in a larger scale. Here 12,500 during a year, either last year or this year, that triggers taxability. If not, then you are still classified as a private person if you are one of these ABCD people. Now, last time we already mentioned this threshold for the half experts is just a favor which we offer to these half experts. And if somebody wants the bureaucracy from the first minute, they can choose to do so. This can be found in 1A4. The acquirer may abstain or refrain from the application of paragraph 3. So you can renounce on the threshold and say, from now on, I want to be subject to acquisition tax. Now, how do you do this? The law here says if you use a value-added tax identification number, which has been issued to you during the negotiations, the business contracts or so with the supplier, automatically is read as renouncing on the threshold. The declaration that you refrain from the usage of your half entrepreneurship status binds you for at least 2 calendar years. The idea here is they don't want to play you, to have you playing ping pong. Let's say I just acquire something on Monday, I renounce on the threshold. I buy something else from another member state on Thursday. I decide to classify myself again as a half entrepreneur and so on. That shall not be possible. Once you decided you are going to learn the regular rules and apply them and act as a taxable buyer, then you should stick for it at least for 2 years. The idea is if you learned it yesterday, now you can still do it today, and only if for a long time you drop out of the scope of the rule where you can justify to hand in a tax declaration. So if your acquisitions drop down to 10 euro for a longer time, then one can talk again about if it's still tolerable to force you, and that is on the option for regular treatment as a taxable acquirer is binding for at least 2 years. Okay. Now, if we go back to the taxability list, number 5 says the intra-community acquisition of a good. We already now know where we can look that up in 1A. It must be in the inland, so we need a place definition. Where does the intra-community acquisition of a good take place? What we expect from our ideas is in the country of destination, because there the tax should go to. But we need the legal confirmation of that. You can't expect from a person who reads the law just to guess what the law means or should mean. You need to write it down. So we need a rule in the Tax Act which says that we have to tax the acquisition of a good in that country where the good goes to and not where it comes from. So let's look for that. And here it is found, 3D. The place of the intra-community acquisition of a good is there in the territory of that member state in which the good is to be found at the end of the transport. Good. Plain and simple, sentence 1. Sentence 2 is about fighting mistakes of the taxpayer. We can talk about that later. The first sentence is the vital and important one, the one which we need at the moment. Now, the second step is we must talk about the tax exemptions. In theory, the second step is always what could be taxable could also be exempt from tax. So we must talk about potential tax exemptions. This will be a very short list probably, because the basic idea which we had in inventing all these rules was, well, we want to use the buyer as taxpayer, so we will probably not free him or her from tax. Only under very exceptional circumstances we are considering to do this. So probably the list of the tax exemptions will be a very short one. And what you need to see first and directly and immediately is that paragraph 4, which lists the usual tax exemption for the seller or the service provider, is not the right list of exemptions for our case. Buying something is something completely different from selling something. And so the legislator decided to establish a separate, different list of tax exemptions for the acquisition case. This is in Germany placed into paragraph 4b, and we should have a look on that. As expected, here it is. Paragraph 4b is the very, very small list of tax exemptions which can be considered in case of an intra-community acquisition of a good. You can immediately store in your memory, put into your brain, however you want to express this. You can immediately see one thing. In most cases, an intra-community acquisition of a good will not be free of tax. You will be fully liable to taxation if you are the buyer in an intra-community acquisition. The small set of exemptions begins with number 1. Free of tax are goods which are explicitly listed here and which can, under all circumstances, always be delivered free of tax. Now, if you can always deliver them free of tax, also buying them should be free of tax. That is the reason why for number 8, letter E, buying currencies, buying money is cash, is free of tax. Number 17, letter A, is even more strange. Buying human blood. For number 17 is who sells human blood and products from human blood is free of tax. The idea is if you are somebody who donates regularly your own blood to the Red Cross, you have, in principle, an entrepreneurial activity. You are independent in that function. You act regularly on a sustainable basis and you get a bit of money for it. On the other hand, it would be rather strange if you are not a small entrepreneur anymore, but for example, the owner of a furniture house. You would have to pay then VAT on, let's say, €20, which you get from the Red Cross for showing up as a donor of blood once in a month. Then probably most people would stay at home. That is why donating human blood is free of tax. Also, delivery of human organs, kidney, so free of tax if one hospital sells such a thing to another. So cross-border acquisition is also free of tax. Ridiculous. So you will probably never come across this. for number 17 in my personal language is usually called the vampire exemption. Was trading in human blood. Who else should be interested in that apart from some medical firms and not you and me? 8.1 is a special exemption for international traffic organizations. Well, goods named in number 4 to 4b. Good number in 4b, for example, on 4a are goods which are delivered into a tax-free warehouse. So if you order something from Paris and you don't have it brought to your own firm, but you order the deliverer that it should be sent to an acknowledged tax-free warehouse, then the acquisition is free of tax, because everything which is inside such warehouse should always be free of tax. For number 8, let us be some financial instruments which sometimes can be sold free of tax. Acquisition is tax-free under the circumstances named there. Free of acquisition tax are also those goods which you can import from a third country free of tax, free of importation tax. For reasons of justice and fairness, imports from other EU states should not be treated in a stricter way than imports from, let's say, Switzerland or the USA. It's relatively rare that you find concrete cases where that applies. One of the interesting cases where it would apply is if you drive with your business car through the territory of, let's say, France, then you need to go to a tanking station. You fill up your tank with fuel there and return home. Then bringing the fuel home from France to Germany is not taxable as an intra-community acquisition, because crossing the border with a tank full of fuel which you bought in Switzerland would also be free of importation tax, so you can legally do it. And some goods which you buy and directly export to other EU countries or other countries in the world, third countries, would also be free of acquisition tax, which is rather a peculiarity. So below the line, you can nearly always write the acquisition is fully liable to tax, because no tax exemption in paragraph 4b applies to my concrete case. The next rule which we then need will be the definition of the tax base. That is usually the same as always. When the buyer pays the tax, that shall make no difference to constellations where the seller shall pay the tax. So the net amount is the tax base as always. 10.1 defines that, no problem. In rare cases, instead of the net price, you take the so-called minimum or replacement tax base in 10.4 of the law. For example, if there is a cross-border transaction between father and son, and father sells a new Mercedes car to son for €1, which is evidently a price which has been manipulated to the disadvantage of the fisc. But usually it's just the regular rule 10.1. 12.1 the tax rate, or 12.2 as always. So if chocolate can be sold for 7%, buying chocolate is 7% too. If milk is 7% when you sell it, buying it is 7% too. And all the rest, where there is no reduced rate, is naturally taxed at the regular rate. That is no problem. The formalities need some additional rules. For example, that the acquisition tax has to be paid by the buyer is naturally something which you need to place clearly into the text of the law, and also the moment when the tax becomes due needs a clear definition. We have rules for this particular case, therefore deviating from the general rules in 13 and 13a. Peculiarities with regard to the invoice cannot happen because a buyer doesn't write an invoice. And also declaration duties are nothing special. You just declare that in your own tax declaration. Let's have a look to the relevant rules here. Here we have paragraph 13a, the definition of the taxpayership. And directly entry number 5 gives us confirmation that in case of the tax on acquisitions on goods coming in from other member states, it is the buyer who is the taxpayer and naturally not the foreign seller, which would be too complicated and would spoil the whole idea. Furthermore, we need a rule on the arisal of the tax. That's usually to be found in paragraph 13. So let's have a look to paragraph 13. So here's paragraph 13. The first lines are missing here on the slide. That is the regulation of the regular cases. And then we have some strange special cases. And special case number 6 is in case of an intra-community acquisition. The tax arises when the invoice is issued, so on the date of the invoice, but at latest at the end of the first full calendar month, which follows the month during which the acquisition was made. So the idea is usually when you get the invoice, you have to declare your acquisition and pay the tax, full stop. Now, people who do not get the acquisition tax back as input tax could try to take refuge to a very, very ingenious solution. Here is the money, please never give me an invoice. To prevent this, you have the second half of the sentence. When the invoice is issued, normally that triggers the tax. But when the invoice is delayed or never coming, then the latest date until which you are allowed to wait to declare the acquisition is the calendar month, the first full calendar month, which ends after the month of acquisition. So if you buy something in February and the invoice comes in June, then first half of the sentence says declare in June, but second half says no. If the acquisition was in February, the first full month, which ends after the acquisition, is March. So at the end of March, you are already obliged to declare the acquisition and pay the tax. This is the sense of this rule here. Now, last aspect which needs to be regulated still is under which circumstances can a person who buys something from another member state obtain the tax which he or she paid back as input tax. That is a bit surprising. You pay a tax and you directly get it back, probably. However, always when somebody buys something for purposes of his enterprise, he usually gets back. So under usual circumstances, you could expect that every value-added tax which an entrepreneur pays for services or here goods which he uses for his enterprise would be given back to the entrepreneur. And in cases where the buyer takes care of the tax paying, that should make no fundamental difference. So here would be a tax declaration, and then you would afterwards be able to claim a refund. However, naturally, the refund claim would be subjected to the usual exceptions in paragraph 15.2 and 15.3. That means if you use acquired goods for the production of tax-free output, then you lose usually the right to claim input tax, apart from cases where we have to do with exportation. So let's have a look on this rule too. Well, here you see paragraph 15, and 15.1 contains the well-known list about of all the possibilities when you can reclaim input tax. First, the tax for deliveries and services made to you by another entrepreneur. Second, the VAT which you paid on importation. And number 3, last but not least, and not even last here in the list, is the tax for the intra-community acquisition of goods for your enterprise if the intra-community acquisition is effectuated in the inland according to 3D sentence 1, which is exactly your case. So in most cases where everything went well, you will regain your acquisition tax very quickly, probably within the same tax declaration as input tax refund. So here you have now the full overview of the rules which you need to check one by one when it comes to an intra-community acquisition of a good. Well, but the first hint for checking cases is when you begin to check a transaction, you should first spend a small thought on the question if the event in question can be an intra-community acquisition or not. That always is the case if a good comes into the inland, arriving from the inland of another member state of the EU, and the person who receives that good in the inland is an entrepreneur or a half entrepreneur who is above the threshold. So your first thought when you're working on a case should be, is it one of the extraordinary cases where I have to test 1 number 5 and not 1 number 1? Beginning to write about the criteria of 1 number 1 when you have a buyer who obtains a good from the rest of the EU would simply be a waste of time. So begin with thinking about that. Now, if it's not 1 number 5, if it's not a case which is suspected or can reasonably be suspected to be an intra-community acquisition of a good, then directly turn to the standard procedure test 1 number 1. Here you have that again. So when it comes to taxability, the first question which you pose yourself is, can it be an intra-community acquisition of a good? In all other cases, you test 1 number 1. In the left case, however, you test 1 number 5 directly for intra-community acquisition of a good, 1A, 3D, 4B, and then you go on as always. Good. Now, how can you recognize as a seller that your buyer is one of the buyers who is liable to acquisition tax? Well, entrepreneurs and those half entrepreneurs who are above the threshold or have renounced on the threshold must get a value-added tax identification number from their country or from every country in which they perform a taxable intra-community acquisition. For example, if you are a German entrepreneur and you order something from France, you can only do this correctly if you have applied for the fiscal authorities for a value-added tax identification number of Germany. You will you will get it soon. On the other hand, even or imagine the case that a German enterprise owner has also the wish to buy something for his establishment in France and has sent something from Italy to France. Then he performs an intra-community acquisition, Italy to France. France is the country of destination. You would have to pay the tax on the intra-community acquisition in France. So there you would also have to apply for a VAT ID number of France and use this to perform the acquisition. If you have an intra-community acquisition, you must communicate your VAT identification number to the delivery so that the fiscal authorities can make a check or control of the transaction possible. The idea is the deliverer in the other country can deliver free of tax to you because there is certainty that you pay the tax in your country. But in order to get away tax-free, the deliverer must be able to prove this, your status as a taxable buyer, and for this he or she needs confirmation that you have a VAT identification number and needs the VAT identification number. If the buyer is not able to inform the deliverer of the VAT identification number, the deliverer cannot confirm, cannot be sure that the buyer is really a taxable buyer. And so then the deliverer needs, probably for reasons of safety, to treat the delivery as a delivery to a private person. So deliverer will then probably pay VAT himself. Now, that would not relieve the buyer of his legal obligation to pay the tax. So in that case, you would have a full double taxation. The acquirer could be caught by the fiscal administration and charged with the tax for an acquisition. The deliverer paid a tax because he could not prove that he himself was not the taxpayer. And so you would just create chaos by not communicating your VAT identification number to your business partners if you have one. It would be an unmitigated double taxation, or even clearer, an unmitigated disaster. Now, if you forgot or didn't receive a value-added tax identification number by the right country in time, you may later communicate the VAT identification number to the deliverer. The deliverer might then be able to prove that his delivery is tax-free because you are the buyer, the taxpayer. And so retroactively he would be able to prove the tax exemption, and perhaps then even could be able to correct the price, lower it down, and the double taxation would fall away again retroactively. But that is only possible under these circumstances. So if you don't do this, or don't do it in time, do it after 10 years, then that would be too late. So then you cannot repair the situation. The chaos would exist and would just be a permanent chaos here. Well, now let us have a closer look to the intra-community acquisition events. I just showed you until now the regular case that you purchase something from another member state, but there are two kinds of intra-community events, to be more precise. The idea is the intra-community acquisition is designed as an event which rather replaces the importation VAT which we have at the border to third countries. So the, let's say, general idea, or the widest idea below the intra-community acquisition, is that persons who can read and write and know about value-added tax should replace the importation VAT levied by the customs officer by the acquisition tax declared by themselves. For that reason, you have not only the intra-community acquisition of a good defined in 1A1, but also the intra-community transfer of a good from one territory to another one in 1A2. The difference is, with an intra-community acquisition, the good is genuinely sold, and the acquirer or the delivery brings it across the border during a delivery. For example, somebody in Paris sells a production machine to a buyer in Munich and sends it to Germany. In that case, you have a genuine sale, and the good crosses the border. The buyer is liable to acquisition tax because the buyer is an entrepreneur and a regular taxed one, so no exemptions, no exceptions. Or German buyer goes to Paris in France, buys a production machine and carries it home in connection with the purchase. Then we still have a genuine sales transaction. We have the good crossing the border, and we have a buyer who qualifies as a taxable acquirer. So we have an intra-community acquisition, a genuine one, 1A. However, the other alternative is, in case of a transfer, we don't have a real sale. In such a case, we have a good which is transported, let's say, from France to Germany, but the owner is the same before and after the border. For example, you have a construction site somewhere in France. There was a construction crane. It has been used there for years. And now the construction project there is terminated and you intend to bring the crane back to Germany. In that case, the crane doesn't change ownership. It belongs to you before and after crossing the border. However, from the idea that the inter-community tax should replace as far as possible what an importation VAT would do, you are now called up to declare the transport of the crane from France into Germany also as a fictitious inter-community acquisition. And that is what 1A2 says. If you bring a good which already belonged to you in the other country, from there to the inland, you will have to declare it as an intra-community transfer so that the fiscal administration gets the information. Now the crane is here in Germany. Such an intra-community acquisition, transfer of a good, is then simply to be treated as if it had been bought for its current market value by you, the buyer, so the recipient in Germany, let's say, and if it had been sold to you by yourself in the other country. So there in the other country, you will probably have to declare, not only probably, but you will have to declare the vanishing of the crane from France as an intra-community delivery from France to yourself in Germany. Okay. If that happens, you just go through the testing scheme. First, 1A2 says a transfer of a good cross-border within the EU is treated as an intra-community acquisition in all times. 3D, it is taxable where the good is at the end of the transport. 4B, there is no exemption. 10.1 doesn't apply. You don't pay yourself any amount. 10.4 replaces it. Take the present market value, pay the tax. 12.1 at the regular rate or 12.2 at the reduced rate, depending on what you transport over the border. And all the rest of the testing scheme is used as usual. As the intra-community acquisition must be in the inland, we have that rule about the place in 3D sentence 1, which we already mentioned. Please remember that. I told you about the intra-community acquisition, that it needs a value-added tax identification number, and now this also is necessary for control purposes. And so if the customer uses a VAT number from the wrong country, you can create a chaos for the whole control mechanism to check if such things have been done correctly. For this reason, if the customer uses a VAT identification number from the wrong country, from the country which is not the country of destination, then in addition to the correct taxation in the country of destination, which you don't get rid of, there is created a second additional punitive tax liability in the country where you took the number of. 3D sentence 2. And the trick is that second punitive tax in the country whose number you used cannot be reclaimed as input tax, because you can only claim the input tax for acquisition of goods which you bought for your enterprise, but not the tax for acquisition of goods which you have to pay due to an error of yours. And that is why mixing up the VAT identification numbers and using some number which has not been issued to you by the country of destination in the concrete case is one of the ways how you can really waste and lose money in cases of VAT. So that's a bit comparable to the cases where you issue an invoice where you confirm, let's say 90% tax, although only 7% is due for chocolate. Then you have to pay the exceeding amount, but the recipient can't reclaim the erroneous exceeding or surplus amount. So exactly same idea, similar reaction. That punitive tax in cases of 14C, you can get rid of it if you rectify the wrong invoice and everything. So if the error is corrected, in cases of 3D2, you can also correct your error by proving to the fiscal authority of the number country that you correctly paid in the meantime the acquisition tax in the correct country. And you get it back, and only then. In principle, however, that is difficult to prove. Nobody in the fiscal administration knows which documents would be sufficient to prove that you paid the acquisition tax for one single transaction in a foreign country or in your own country. The only thing you could recommend is that somebody from the correct fiscal authority gives you a document, perhaps written individually, where they just confirm that the taxation has taken place of this individual taxation acquisition and that no further tax claims against you exist anymore. That would probably, if you can obtain such a letter, that would probably already be sufficient proof. Yeah. The legal source for this second additional punitive tax is 3D sentence 2. So keep in mind that sentence 2, you have to pay acquisition tax in the country where you took the number from. It's not an option to get rid of sentence 1. It is an additional tax. So if you are an enterprise owner and have a good send to Paris, and you use a German identification number during that transaction, you just have to pay tax on the same acquisition in 2 territories. In Paris, because the good ended up there, sentence 1, and additionally in Germany, because you used the German number. So here we have again relativity of time and space, as in physics. You have one acquisition, and during according to the rules of the law, it has to be taxed in 2 different places at the same time. Nice and strange, naturally. Okay. So for solving a case in an exam, it would therefore be recommendable first to check the country of destination and say that the acquisition is taxable there, and then to check which number has been used, if it was the identification number of the correct state, or if the acquirer used the ID number of the wrong state, because then you would add the statement that an additional tax is triggered in the number state. So I would develop the habit to say the good ends up in Paris, 3D1, that's a place where the acquisition is taxable, and then to write this is not changed by 3D2 because the correct number has been used, or additionally 3D2 triggers an additional tax in, let's say, Germany, because for the acquisition a German number has been used, although a French number would have been correct. If you come in a case to the effect, so the consequence that you have 2 places of acquisition, sentence 1 and 2, then you later will have also to calculate the tax burden according to the tax rates of both countries, because then you have 2 tax liabilities. And then again, you will have later to differentiate when it comes to input tax claims, because then for the one tax, you get an input tax claim for the right one, and for the wrong number state tax, you don't get an input tax claim until you correct your error. Okay. When it comes to the tax exemptions, please remember that you don't use the usual list of exemptions in paragraph 4, but that you use a list in paragraph 4b, and so that it is very, very short, and so usually does not apply. The 4 tax exemptions were certain goods which you always can buy tax-free, certain goods under the circumstances under which they can be sold tax-free can then also be acquired tax-free. The rule concerning the exemption for goods which you could also import from third countries free of tax, and goods which you import from another EU country into the inland in order to directly re-export them to other countries. Yeah, so that's relatively simple. We already mentioned that the tax base is the same tax base as always, so the net amount. However, you must clearly see that because the customer has to pay the tax, the price which the customer pays is automatically the net amount. It does not include value-added tax. You can see it on the next slide here. The buyer or acquirer pays 10,000 euro to the seller, and the VAT is paid to the fiscal office. So the VAT is not included in the official price in the contract. It has to be paid on top of that price. So the 10,000, the price paid to the seller, is automatically a net amount. So it might sound very much like a gross amount. For example, here, if the buyer pays 11,900 euro, then nevertheless it is automatically a net amount because the VAT has to be paid by the acquirer or buyer on top of that amount to the fiscal office. So it's automatically a net amount. This is one of the most fascinating traps in the solution of a case in an exam or so. That the taxpayer is the acquirer is something which we already mentioned, 13a1 number 2. And well, the arisal of the tax, we also mentioned that there is a special rule in German tax law which says that tax arises when the invoice is issued, but not later than at the end of the first full month after the acquisition took place. Just to hinder people from things like, here is the money, please never issue an invoice, in order to avoid the arisal of the tax. Yeah, so when it comes to a tax case in an exam, so you will have to determine both dates and then to state that the arisal of the tax is at the earlier date. Invoicing rules do not exist. Declaration duties, yes, you have to declare the acquisition in your tax declaration. Any peculiarities, no, apart from if you did not mention it before. Check again if 3D sentence 2, that additional penalty tax or punitive tax for using the wrong number, if that applies or not. And then say something to the input tax declaration, 51 number 3. So, well, all not very complicated. So, yeah, you should note that due to the fact that the acquisition tax is usually refunded as input tax, we have probably no problem if you make an error and pay too high a regular acquisition tax. It does no harm. You can pay it and reclaim it, because if the error is detected, the tax inspector will automatically have to correct the tax which you wrongly declared and the tax which you wrongly claimed. There is no rule which says over-declaring an acquisition tax in a tax declaration is treated correspondingly to writing out an invoice confirming too high a tax rate. So no problem there. Only using the wrong value-added tax identification number can cause you financial problems in that area. So for this reason, forgetting one of the exceptions in 4B, USDG might not create serious problems or harm, because if you over-declare and declare tax for a tax-free transaction and reclaim it, the rectification of your tax declaration will make both entries vanish, so the effect is plus minus zero. For this reason, the German Fiscal Administration even says if you ignore one specific exemption here for B number 4, a tax inspector should not bother to criticize that. Wow. So to sum up, the tax for an intra-community acquisition of goods is usually immediately paid back as input tax refund. So apart from a very few cases where the acquirer does not have the right to full input tax deduction, let's say if you are an insurance company or a bank, the whole procedure of having to declare intra-community acquisition does not bring any tax revenue for the fisc, because it's just plus minus zero. That brings up the question why the whole thing is done. And surprisingly, although it's not about money in most cases, the whole procedure of the acquisition tax is extremely important and a vital part for the functioning of the VAT system in Europe. And that's not easy to understand, because you always think taxes are about collecting money. But here it's not. Only the fact that the acquirer has to declare what he, she, or it, whatever it is, bought things from another member state makes it possible to check if what the supplier told his tax authority in the country where the goods came from was right or wrong. And that's a problem. Well, that's vital, because only this duty to declare the existence of the goods which you bought from somebody else, let's say in France, only that can hinder the goods from vanishing into nowhere. And so to go into the free market, in the single market or internal market of the EU without ever having been taxed. Because if you had no acquisition tax declaration, you could do the following thing. Somebody in France says and proves, I delivered goods to somebody in Germany, gives the name and so on. So remains free of tax. Now, that good leaves France without having been taxed. Now, the German acquirer, if that German acquirer doesn't declare the acquisition of the goods, they are not within his or her bookkeeping, perhaps. At least you could just buy them without recognizing them in the books. That would have the advantage that you could sell them later undercover, unnoticed, in the dark of the night. So you could resell them untaxed, and so the goods would circulate through the market untaxed. So the acquisition tax hinders the acquirer from hiding the acquisition and the resale from the fiscal authorities of his own country. If you now say the supplier only gets a tax exemption for an inter-community acquisition in his country, if he gives us the VAT identification of number of the acquirer and the acquirer has declared the acquisition, then we can be sure that the goods who left the books of the supplier free of tax must show up in the next step in the books of the buyer, and so can never vanish completely from that sphere which the fiscal authorities can control. There is naturally another alternative. You could also have the deliverer cheating, selling the goods free of tax to somebody living in France, but telling the fiscal authorities my buyer was somebody in Germany, trusting that the fiscal authorities of France cannot go to Germany and check the situation. For this reason, you have that system that in Germany, the buyer has to declare the acquisition, so that then the fiscal authorities of France can contact the fiscal authorities of Germany. Hello, our French entrepreneur Peter Paris from Paris told us that he sold goods for 1 million to an enterprise in Munich. Does that enterprise in Munich know about that transaction? Did they declare that? So they can check if the two book entries match. And that is the vital function of the intra-community acquisition of goods. It is not about the money, it is simply to secure that goods do not leave one country untaxed, free of tax, and never show up again in the bookkeeping of the buyer. And so they established a mechanism that information is automatically exchanged about the delivery from the deliverer to the acquirer, where the fiscal authorities can then check, does the information declared in both bookkeepings match? So if the deliverer in France declares a delivery of 1 million to somebody in Munich, does that amount of 1 million show up in that person's tax declaration? So do the figures match, or do they deviate? And if they deviate, something went wrong in the declaration of either the supplier or either the acquirer. So the fiscal authorities of both states can begin to inquire with concrete measures to check up where the mistake was made and to find who made a mistake or who even tried to commit tax fraud. So that's the whole sense. So let's sum this up. The underlying idea is not to collect taxes in most cases. The idea is if the goods in question are declared as tax-free by the deliverer, they will only be accepted as tax-free if the acquirer declared them and registered them again in his or her bookkeeping. So no good can vanish from the supervision of the fiscal authorities without being taxed. Now, if the goods are once registered in the bookkeeping of the acquirer, they can no longer be hidden by the acquirer, and so if they later vanish from the books of the acquirer untaxed, the acquirer will have to present a very, very good explanation to his fiscal authorities, which is usually not possible. And so the duty to declare inter-community acquisitions, even if it brings no tax revenue in the end, is absolutely vital for the surveillance of the enterprise activities in the internal market, and that, and only that, is the most important motive behind the existence of that whole tax on intra-community acquisitions. So keep in mind, in most cases you will have in the last step, an acquirer can get the whole thing refunded. But that also explains why nearly no intra-community acquisition will ever be tax-free. You need the amount declared in the tax declaration of the acquirer in order to check if the numbers declared in the declaration of the acquirer and of the supplier match. If there is a deviation, something is wrong, and you will start investigations. Well, now you have seen that in order to have that system functioning, that we need also certain activities undertaken by the deliverer. We need also a declaration of the intra-community delivery of goods in the country where they come from. Otherwise, you have no chance to see if these two declarations, country where the goods come from, country where the goods go to, if they match. And so we also have to talk about the treatment of the deliverer. That is called the intra-community delivery of goods, and that is where we're going to speak immediately about now. So now let's turn to the discussion of the treatment of the deliverer of the good in case of something which is an intra-community transaction with a good. We must, under all circumstances, keep in mind now that in the system of VAT legislation there is a strict parallelism between what is an intra-community acquisition on the side of the buyer and what is then called and treated as an intra-community delivery on the side of the deliverer. It is, for this reason, never possible to have a transaction which qualifies as intra-community delivery for the deliverer if the underlying transaction is not on the other side classified as intra-community acquisition for the acquirer, and the other way around. So an intra-community delivery can only be talked about if you have cases where the first step of our three-step with different solutions, if the first step, the optimal solution, applies. So never use the term intra-community delivery in other cases. Well, furthermore, from that strict parallelism, it follows that we can already deduce that there will be two kinds of intra-community deliveries. There is first a delivery which is a genuine sale, because when you have an intra-community acquisition, there is first and most frequently the case where the buyer really buys something from another member state, and so there is the corresponding case for the deliverer that the delivery really sells something which is then carried to another member state. So the delivery can be classified as a genuine delivery, transfer of ownership to another person. There was, however, for the intra-community acquisition also that case that somebody already owned a good and just transferred it to another member state for a longer time. And that then the intra-community acquisition was a kind of replacement for the importation VAT, which you would have paid when you crossed the border from a third country. Now here, when you cross with a good the border of an EU country, then there is no customs officer, no customs duties anymore, no customs declaration. So the person who crosses the border, if he or she is an entrepreneur, is just called up to declare the importation VAT in form of acquisition VAT himself. So an intra-community transfer of a good which is not sold can also be treated as a delivery fictitiously, because on the other side of the border it will be treated as a fictitious inter-community acquisition. In such a case, you will have to make a rule which says, and only in such a case, although it is not genuinely a delivery, we do as if it were a delivery, 3.1a of the USTG. I could even try to show you this small rule, and I think I do it. So as you can hear, as you can see here, not as you can hear, see. As you can see here, paragraph 3.1 is just a definition of a genuine delivery. You sell something to somebody else so that the position of an owner changes in a tangible good. That can be applied to every genuine cross-border sale, so that will be your starting rule for all intra-community deliveries. However, when you have an intra-community transfer of a good, which is just transported from one country to another without changing ownership, so that you have a fictitious transaction, then you need a rule which says, okay, you should treat it as if it were a delivery. So that is to be found in paragraph 3.1a, as delivery of a good for consideration will be regarded. So is not, but will be regarded as if it were the transfer of a good which belongs to an enterprise from the inland, which belongs to an enterprise from the inland into another part of the European Union VAT customs territory or VAT territory or customs territory by the entrepreneur, not to sell it, but for his further own use, except for a transfer which is only of a very temporary nature. The entrepreneur is then deemed to be the vendor, the seller. Okay, so that's again something nice. And now we must think about how should we treat the deliverer in an intra-community delivery of goods. Well, as we have already said, the deliverer should have obligations. He should be forced to declare something and to prove that he used the goods in a tax-free way. In order to achieve that, we must make the delivery taxable. The sale should be a taxable transaction. It should be taxable, well, in which country? The deliverer will have to justify himself in the country where the good was last seen before it vanished. Because there the fiscal authorities will say, hey, you had some goods with a value of €1,000,000. Now they are gone and you have money in your bank account. So why was VAT not paid? And so you will have to justify yourself. I sold to somebody in another member state and it was a registered acquirer with a VAT ID number, and I can prove that it went to another member state. So I'm free of tax. But the decisive thing is, under which circumstances can your fiscal administration only demand such proofs? Only if the law applies to you. And so in the country where the goods were before they were sent to the buyer, you need a taxable transaction. So you need that it is classified as a delivery, that was 3.1 or sometimes 3.1a, and that the place of delivery is in the country of origin. That can be achieved by the absolute basic rule 3.6, sentence 1. The place of delivery of a good is always in the country where the transport or other movement towards the customer began. That is always the country of origin. That's always that country where the good was last seen. So where the fiscal administration will have questions to the entrepreneur. Hey, you had goods, now they are gone. Hey, either pay or tell. Huh? Tell us what happened and prove it so that we renounce on the tax. And if you can't prove the exemption, then you will have to pay. Only that gives the right incentives to the deliverer to have the documents clear, to declare everything in a nice way, and to make sure that his declaration matches with the declaration of the acquirer by registering the right VAT identification number, handing over the relevant information to the automatic information exchange system of the EU in the so-called recapitulative statement, so that by computer the matching of the declarations can be checked. Well, so you need a taxable transaction in the first step. So in case of the intra-community deliverer, it must always come out the thing is taxable in the country where the goods come from. 3.1, 3.6, or 3.1a in rare cases, and 3.6. The next step must then be that the transaction will have to be tax-free, because the tax is finally and actually paid by the acquirer and the country where the good goes to. So the deliverer should not have to pay a tax. However, that strictly requires that we have a taxable acquirer on the other side. So for a genuine intra-community delivery, we need to check if that is the case, and that is what our deliverer will have to prove to us. First, the acquirer, first the good must cross the border and go into another member state. Otherwise, you don't have an intra-community transaction of a good. So you will require under the first number in 6a proofs that the good was brought to another member state. either by documents from the package service, or by other confirmations, or even by a written confirmation of the buyer, if the buyer transported the good himself, a written confirmation afterwards that after the transport, the buyer confirms to you, yes, I successfully brought that good to my member state. Well, the next thing is an intra-community acquisition can only be made and declared by a person who can, from the perspective of VAT, read and write. So if that acquirer belongs to the group of the full entrepreneurs, or belongs to the group of a half entrepreneur who has exceeded the threshold or renounced on the threshold and thereby acquired the status of a taxpayer for acquisition tax. The acquirer must then be indeed subjected to acquisition tax in one of the member states. This condition is nearly always fulfilled if the buyer uses a correct or a valid VAT identification number, even if it comes from a wrong country, because a buyer who brings a good to France and uses the ID number issued by Spain to him has to pay on that acquisition the punitive acquisition tax in Spain additionally. So you can already by having the Spanish number, prove that at least in one other member state the acquirer is subject to acquisition tax. So that would be sufficient to prove your tax exemption here. And number 4, recently added to the tax laws of the member states, the acquirer must also have communicated his or her VAT identification number deliberately to the deliverer during the transaction. So must have said, I buy this under my VAT identification number. That was always nearly between the lines, because you could never successfully really prove that your acquirer was an enterprise owner if you were not able to have the VAT identification number. But in order to clarify things, that it's really needed and that it's not sufficient to say, yes, due to the nature of my good, which I sold a production machine for 2 million, it's evident that my acquirer can only have been an enterprise, although I can't say the name. So they added this to the list. You have to name the acquirer, and you have to, so not only to prove that the acquirer must have been an entrepreneur, but also that you are forced to identify him or her by having the VAT identification number in your files. And for that, number 4 has been added. The VAT identification number of the acquirer must have been communicated to you, and you naturally are then required to register it and not to forget it. So in that second step, the transaction will have to be tax-free. In case where we have only an inter-community transfer of a good, so where you owned a good which was in France or which was in Germany and then was transported to France, and in France remains your property, there we would have a fictitious delivery under 3.1. Then the place would be determined under 3.6, and later we would declare it as tax-free under intra-community delivery in the same case. So both would be tax-free under these rules, the genuine one and the deemed intra-community delivery. But the tax exemption for the intra-community delivery in both cases is subjected to the condition that you correctly communicated all the transaction to the fiscal authorities in your own state in the so-called recapitulative statement. which is an additional tax declaration which you have to make electronically, where you have to give the net amounts and the VAT identification numbers of all the acquirers during the last declaration period, so that the fiscal authorities can identify which acquirer from which member state during the last period, for example a month, bought which amount from you, and can then compare with the tax declaration for acquisition tax of these acquirers and check if it matches or not. If you did not fulfill this formal requirement, then the tax exemption for the delivery is strictly not granted. So then you have to pay the full tax until you correctly fulfill these declaration duties. That means if there is an error or even a tax fraud, then it will come up that the two declarations don't match. There will be investigations. You either will have, if you wrongly declared in the recapitulative statement, you will have to rectify it. Then from that moment onwards, there will be a tax exemption granted to you, or it will come up that the acquirer has tried to hide the acquisition. Then measures will be taken against the acquirer, or if things remain unclear, then investigations will start into the behavior of both until there is certainty what went wrong. So that's excellent to follow up the fate of a good. Just to repeat again, the intra-community transfer of a good. There, the tax exemption is regulated in a far simpler way that you don't need to check for things. It's always automatically tax-free. However, again, only under the condition that it has been correctly communicated to the other member state in the recapitulative statement, which makes it sure that an entrepreneur cannot shift goods to another member state and then sell them there without that the fiscal administration of that country knows about it. Imagine you have a construction crane with a value of, let's say, several millions here in Germany, and now you shift it to France and sell it there. Well, the Germans will ask you what happened to the crane, and you say it's not your business, I shifted it to France and later sold it there. So the Germans would have to accept that they have no claim to the tax, but they can't check it. On the other hand, the French would never have got the information that you had a crane there and sold it there because it was not in your books there. And that is, again, the ingenious background of that acquisition tax system. The German law says, well, you only, if you tell us that we are not capable to tax a good which belonged to your enterprise because you brought it to another member state and sold it there later, so that the place of delivery is not here but there. Okay, then we accept that. But if you bring that forward, that is automatically classified as a fictitious intra-community delivery to another state. So it is automatically declared as a taxable transaction. And a taxable transaction triggers the full tax if you can't prove the tax exemption. And here the rules say, okay, if you bring forward, I brought it to France, it's automatically accepted as tax-free. The only requirement is that you only get the tax exemption if you correctly declare the transfer of the crane to France. And that means the French get the information that now the crane was in their territory. And if later the crane begins to vanish from your books in France, next tax inspection comes and the crane is no longer there, then the French will ask you for questions. And now they can ask you questions. Where is the crane? And so if you try to sell it undercover, unnoticed in the dark of the night, you will fail because you had a book entry named C from examining the books. There was the crane in our territory. And now when you try to sell it tax-free undercover, unnoticed, you will have to present them a very good explanation. You might again say, not your business. Afterwards, I transferred that crane to Spain. But then again, they ask you, okay, if you bring forward, you send it to Spain, information, this is already that you admit you did a taxable transaction, transfer of a good to Spain. It's automatically tax-free if you declared the acquisition. So the coming in of that crane to Spain, can you show us that you did that correctly? If so, congratulations. If not, then you have a taxable transaction which you admitted yourself. You have no right to a tax exemption up to now. And so you have to pay the full tax on the market price on the crane when it vanished from the supervision of the authorities in the moment when you say you brought it abroad and it got lost from the books. So that's an ingenious system, which is absolutely perfect. This makes it virtually impossible to commit tax fraud by just pretending that you brought a good to another country and then it got lost from the books. Well, the system is always, if you say, I delivered a good intra-community, either fictitiously or genuinely by selling it to somebody else, you only get a tax exemption if it's made sure that on the other side, that item shows again up in the books of somebody who owned it on the other hand or other side of the border. So that's a perfect system. And the main idea is not securing the money. The main idea is securing that goods do not vanish untaxed into nowhere. Now, naturally, some remaining details. In order to make it possible that you can declare the amounts of intra-community deliveries in the recapitulative statement and in your tax declaration, it is also necessary that you are able to determine the tax base in such a case. This is again, as usual, either under 10.1, the net amount, or in very few cases, where a consideration or a price does not exist, for example, in case of intra-community transfer of a good where the good is not really sold, or where the price might be manipulated downwards. For example, if you sell something cross-border to a subsidiary or another closely related person, then it might be the minimum tax base under 10.4 number 1. So nothing really special. A tax rate and a tax amount do naturally not occur for the delivery because the intra-community delivery is tax-free. It might, however, make sense to determine who is the taxpayer in the sense of who has to deliver the duties under the law, because you need to determine who has to hand in the tax declaration on the tax-free delivery, who has to make the recapitulative statement, and all the rest. So taxpayership makes sense to answer about that. For the same reason, the arisal of the tax might make sense to be determined, because you need to know when you have to declare it and when you have, or for which period you have to enlist the transaction in the recapitulative statement. So that makes sense to determine these points here. And naturally, that you have to declare it in the tax declaration also makes sense because the fiscal authorities want the information. There was a transaction and they want to be able to check if the conditions for the tax exemption were really successfully met. Well, one might, if you solve a case, add under position number 6, are there any peculiar, strange aspects which the normal testing scheme does not cover? You might add that you have to hand in a recapitulative statement in addition to the normal tax declaration. And furthermore, you should mention something about input tax claims. Here, naturally, the output tax is 0, and that always triggers the question, if I have a tax-free output, does that hinder me from claiming the input tax on my input goods and services? Under normal circumstances, that would be the case. However, if you export goods to other country, there is a rule that you still can claim or keep your input tax claims for the raw material, the services needed, other things to produce your output, because export is genuinely and completely free of tax. So there should be no tax on the output, but also no tax on the input. So you get your input tax completely back. You can keep the input tax claims in spite of the tax exemption for your output. That should be mentioned in case of a case solution here. To sum up here, when we have to deal with the EU cross-border case, then you first test if it qualifies for that optimal solution in our testing scheme. That is the case when the buyer is somebody who, from the perspective of value-added tax, can read and write, so knows the rules and has a bookkeeping, or can at least be expected to be able to learn the rules. So in that case, we have to distinguish then the treatment of that transaction in the goods where it came from, and the treatment of the same transaction in the country where it goes to. That leads to the following overview. The treatment of the deliverer. When it comes to taxability, it will be taxable. Paragraph 1.1 number 1. It's either a delivery genuinely or it is a deemed delivery if it's just a transfer of the good without a sale. The place is 3.6 where the movement of the good began. Tax exemption is granted. That's nearly always a yes under 6.1. 6A1 or 6A2 plus for number 1 letter B. On the other hand, treatment of the acquirer. For the acquirer, the taxability is regulated in a different number because the acquirer doesn't have a delivery, the acquirer has a purchase or an acquisition. So there is an additional list. 1.1. Acquiring a good from another member state is taxable, and the two cases are either 1A1, a genuine purchase from somebody else, or 1A2, you bring a good to the inland which already was for a long time ago your property in the other member state, and now you just transferred it to the inland. The place is in both cases 3D, sentence 1, where the good ended up at the end of the movement of the good. A tax exemption for an acquisition is, in contrast to the delivery side, nearly never given, so it's nearly always taxable. The tax base must now be the same on both sides, otherwise you can't see if the declarations match or not. So the tax base is 10.1 for the deliverer in most cases, and 10.4 the minimum tax base in rare cases. The same on the other side for the acquirer. Tax rate and tax amount not relevant for the deliverer, but regular tax rates for the acquirer. He or she has to declare the full amount. Formal aspects, taxpayer. For the deliverer, yes, the deliverer is taxpayer, has to make a tax declaration. The arisal is when the delivery happens, has to write out an invoice where he or she has to write a net invoice, has to give a hint that there is a tax exemption, and has, for reasons of control, to name the VAT identification numbers of himself and of the acquirer on the invoice. On the side of the acquirer, we have the rule that the acquirer has to pay the acquisition tax 13A1 number 2, and when the acquirer has to declare the acquisition. Peculiar aspects, recapitulative statement for the delivery, and nothing special for the acquirer apart from the punitive additional tax for using the wrong VAT identification number, that punitive additional tax is absolutely necessary, because by using the ID number of a wrong state, you spoil the functioning of that whole supervising system, and that is why you should be punished for it and be brought to comply with the rules by applying for a VAT identification number in the right country, in the country where the good went to. Input tax questions, there you would mention that you retain the right for input tax as deliverer for your input. And the input tax question on the side of the acquirer is a simple one. The acquirer in most cases can obtain the acquisition tax fully back as input tax, apart from the cases where the acquirer uses the acquired good for tax-free own purposes. For example, if the acquirer is a bank, an insurance company, a medical doctor, or something like this. So in most cases, I underline that again, the whole thing with intra-community delivery and intra-community acquisition is not really about the money. It is about supervising the fate of the goods which are allowed to leave a country or to leave the hands of an enterprise tax-free, to secure that these goods do not vanish tax-free into the market, but they must show up again in the books of another enterprise owner in the other member state, so that they again cannot vanish unnoticed into the market, not unnoticed and unpaid, because otherwise the market would break down if some people could, undetected and unpunished, sell their goods free of tax in the dark of the night to customers, to final customers. That's the whole same sense of that system. Okay, that was now the first alternative, the first step, the first possible solution for cross-border transaction of goods within the European Union. And this is still today the most frequent case. So let's have a break, and on the second alternative, what happens if you sell to a private customer in another member state? On that second alternative, there will be another video soon. Thanks for watching, and goodbye.